All right, let's get right into it. When one of the world's richest people makes a multi-billion-dollar move, you know everyone's going to pay attention. But what's really interesting this time isn't what Bernard Arnault is buying, it's what he's buying back.
3 billion euros. Just let that number sink in for a moment. That is the jaw-dropping amount Bernard Arnault's luxury empire, LVMH, just dropped in one single massive move. And a number that big, well, it immediately brings up a huge question.
I mean, seriously, why would a company that's at the absolute pinnacle of its industry, a global giant, spend 3 billion euros just to buy its own stock off the market? That is the puzzle we're going to piece together in this explainer. To really get to the bottom of this, we need to unpack what I'm calling the 3 billion euro question. Because trust me, this is not just some boring financial transaction. It's a very calculated move from a master strategist. Okay, so here's the deal. LVMH, the powerhouse behind brands like Louis Vuitton, Dior, and Tiffany, pulled the trigger on this massive share buyback. Now, the Arnault family already controls just under half of the entire company, so this move is all about tightening that grip and really cementing their control.
So what exactly is a share buyback? The easiest way to think about it is like a pizza. Imagine the pizza maker buys back one of the slices he already sold. Suddenly, there are fewer slices available for everyone else. That means each slice that's left is a bigger, more valuable piece of the whole pie. It's the same idea for a company. It just reduces the number of shares out there, which concentrates ownership and can boost the value of the stock that remains.
But why now? The timing of this move is absolutely everything. And that brings us to the backdrop for Arnault's decision. After years of just scorching hot growth, the global luxury market is finally starting to cool off a bit.
The reality is, the incredible, decade-long party in the luxury world seems to be winding down. Valuations are coming back down to earth, China's big economic rebound hasn't been quite as strong as everyone hoped, and even the wealthiest shoppers are starting to be a little more picky. The market is, well, it's normalizing.
So, in this shifting environment, what does a billionaire do?
Well, this is where we get to see Bernard Arnault's playbook in action. And let me tell you, it is a masterclass in how to move when the easy growth starts to disappear. And this comparison just lays it out perfectly. The old playbook, especially when things are booming, is all about empire building, right? Go out, buy other companies, expand, no matter what it costs. But Arnold's new playbook, it's the complete opposite. It's about locking down control, being super efficient with cash, and making the company's foundation rock solid. It's a defensive play, for sure, but an incredibly powerful one. And here's the really crucial part. LVMH is sitting on an absolute mountain of cash. We're talking more than 15 billion euros. So instead of letting that cash just sit there or chasing a risky new acquisition in a cooling market, Arnault is using it to buy back and retire shares. This does two brilliant things at once. It increases his own family's financial stake in the company, and it helps support the share price for everyone else who's invested for the long haul.
And you've got to understand, an action this big isn't just about shuffling money around internally. Oh no, it is a huge, flashing signal to the entire global market.
I just love this quote from an investment banker who was close to the deal. When founders deploy capital to reduce float rather than chase acquisitions, it signals long-term confidence in intrinsic value. In simple terms, Arnault is betting on himself. He's telling the world that the absolute best investment he can possibly make right now is in his own company. And that sends a crystal clear message to everyone else watching, from Wall Street traders to other super wealthy families. The boom times might be slowing down, but the fundamental value of these iconic generational brands is solid as a rock, and it's worth defending aggressively. So this brings us to the real philosophy behind this entire 3 billion euro move. It's an idea we can basically sum up as control is the new growth.
Because when you look past all the headlines and the massive numbers, you start to see the deeper truth of how this kind of dynastic wealth is actually protected and grown over the long term.
And here it is, the key takeaway. For the ultra-wealthy, true, lasting power isn't always about non-stop expansion. It's preserved through disciplined control. It's about knowing exactly when to stop chasing growth, when to strengthen your own foundation, and when to use that control at the perfect moment in the cycle.
So it all leaves us with a really fascinating question to think about. As the global economy gets more and more unpredictable, and the future looks a little less certain, is playing smart defense the new best offense? Is holding and consolidating power now more important than just chasing growth? It's definitely something to chew on.